So again, I hope you've got your notes printed or you've got some paper with you because we're going to close out the accounting cycle now with the closing entries, and you want to make sure again that you're engaging, that you're writing these down, you're taking good notes, you're pausing the video and trying to work through the problems and then restarting it to check your answer and listen to the explanation. So once we've got all of the financial statements completed for the year, the next thing that we need to do is do our closing entries. The closing entries zero out what we call temporary accounts. So there are certain accounts that we want to zero out at the end of the year so that we start over the next year with a zero balance. If you think about it, the income statement measures our profit, our revenue and expenses over a period of time, over typically a year. So that means we want to start the year with a zero balance so we can measure how much revenue we earned. And we want to start the year with a zero balance in our expenses so we can measure how much expenses we incurred over the year. So we want to start those accounts with a zero balance. But not all accounts do we want to zero out, right? Our asset accounts don't get zeroed out. We don't start off the year with zero assets. We don't zero out our liabilities, unfortunately. We don't get to start off the new year with zero debt. I wish we did, but it doesn't work that way. So all of the accounts that appear on the balance sheet are what we call permanent accounts. They are not closed, they carry forward. So that's assets, liabilities, common stock, and retained earnings. Anything that does not appear on the balance sheet is a temporary account and it does get closed out. That's revenues, expenses, dividends, and then you'll notice there's an account listed there called income summary, and we'll talk about that in just a moment. So closing entries are the last set of entries that we do to zero out our revenue, our expense, and our dividends. Now remember we said retained earnings is kind of like our corporate savings account. It's where we're going to transfer all of our profit at the end of the year. So this closing process is how we transfer that profit into retained earnings. It's also how we take dividends out of retained earnings. We're going to do a closing entry to dividends and take them out of retained earnings. So that ultimately, when we're through with this, the balance in the retained earnings T account will exactly match what we said it should be when we did the statement of retained earnings earlier in Objective 1. Now, there are different ways that you can do the closing entries. I say different ways, there's two ways. One way involves closing out directly to retained earnings, and one way involves using what's called an income summary account. I'm going to teach you how to do it using an income summary account. If you go on and take some more accounting classes, you may not use an income summary account. You may learn how to close them out directly to retained earnings, and that's perfectly fine. GAAP allows you to do either method. So the closing process, this is just a kind of an overall diagram. The first thing we want to do is close out revenues and move them into income summary. Then we're going to close out expenses and move those into income summary. Then we're going to close out income summary to retained earnings, and then dividends are going to go directly to retained earnings. So let's walk through this process together. So in your notes, remember you have that adjusted trial balance that shows all of the balances. So that's where we're going to pull all of these numbers. So if you look back at that adjusted trial balance, you'll see that service revenue has a $17,500 credit balance. Revenues have a normal credit balance. So if I were wanting to close out revenue or to zero it out, then I would need to debit the revenue account. So I would want to debit revenue for $17,500. Now remember we said back in chapter 2 that we always credit revenue except for one time a year. This is it. This is that one time of year that we're ever going to debit revenue, and we're literally only going to do it once, right? So I'm going to do a journal entry to debit service revenue and then credit that income summary account for $17,500. So if I look at the service revenue account, it now has a zero balance, and income summary has a credit balance of 17,500. Now the next thing I need to do is zero out all of my expense accounts. So I had a bunch of expense accounts, but if you're looking at that adjusted trial balance, remember they all have debit balances. But if I want to close them out, then I need to credit them, to zero them out. So I'm going to do a journal entry where I credit each and every one of those expense accounts, to zero every single one of them out, and then I'm going to debit income summary for the total. So here's what that entry looks like. So this is a compound entry where I have lots of credits, but as long as they total to the same amount of my debit, that's okay. So I've credited rent expense and salary expense and supplies expense and utilities expense and so on and so forth. And then I debited income summary for the total. So now when I look at the T accounts, all of the expense accounts will have a zero balance. And income summary had a credit of 17,500 for revenue. It has a debit of 89.50 for expenses. So that leaves us with a credit balance of 8,550. And I bet if you look back in your notes at what our income statement looked like, we showed net income of 8,550. So now that I've got income summary, which is the account that summarizes net income, I want to close this account to retained earnings. So since income summary has a credit balance currently, to close it out, to zero it, I would want to debit it. So to close income summary to retained earnings, I would want to debit income summary and credit retained earnings. Okay. Now remember, aid reveille with me, the O in reveille stands for owner's equity, which we said was common stock and retained earnings. That tells me that retained earnings has a normal credit balance. So when I credit retained earnings for 85.50, I am increasing the retained earnings account. Does it make sense that net income would increase retained earnings? If you remember to our statement of retained earnings, remember we add net income. So net income should increase retained earnings, so this makes sense. Now, if we had a net loss, this would all be the opposite, right? So now when I look at my income summary T account, income summary is zeroed out, and retained earnings no longer has a zero balance. It has a balance of 85.50, which is the net income. Now the last thing that I need to do is close out dividends. So if you look back at that now, dividends, if you're looking at that adjusted trial balance, have a debit balance of 5,000. So that means to close them out, I want to credit the dividends account. Now, dividends don't go through income summary. Income summary is only income statement accounts. So they go directly out of retained earnings. So since I'm crediting dividends to zero it out, I'm doing the opposite of its balance. That means I have to be debiting retained earnings. Now remember, we said retained earnings has a normal credit balance. So if I'm debiting retained earnings, that means I am decreasing retained earnings. Does it make sense that dividends would decrease retained earnings? Well, remember on that statement of retained earnings, we subtracted that 5,000 of dividends. So that does make sense. So now when I look at my retained earnings T account, we'll do the journal entry on the next slide, I promise. We have retained earnings has a debit of 5,000, a credit of 85.50, so that leaves us with a credit balance of 3,050, which is exactly what we said that balance should be on the statement of retained earnings. And dividends have been zeroed out. So now that journal entry is a debit to retained earnings and a credit to dividends of 5,000. So this is just a summary of all of those closing journal entries. We're going to make these same 4 closing entries every year. They never change. The amounts change. Maybe some of the accounts change. Maybe instead of rent expense, we'll have um, something else, but we're going to always close out revenue, always close out expenses, always close out income summary, and always close out dividends, except remember, corporations are not required to pay dividends. So if a company didn't pay dividends, then you have no dividends to close out. So when you're working through your homework, if you don't have any dividends on the adjusted trial balance, well, then you just don't have to do that last closing entry. There were no dividends that were paid. You don't have to close them out. You'll always have the first three. You may or may not have the fourth one to close out dividends. And so this again is just a review of all of the T accounts. So now we can see all the expenses are zero, the revenue is zero, the dividends are zero, income summary is zero, and retained earnings is that 3,550 that we said it was going to be way back on that statement of retained earnings we did in Learning Objective 1. So the last step, the very last thing we have to do before you can go home is what's called the post-closing trial balance. So just like the other two trial balances we've done, the post-closing trial balance is just a list of all accounts and their balances at that point in time. However, just like before, we don't include accounts that have a zero balance. So that means there's going to be no revenue, no expenses, no dividends, and no income summary on this adjusted trial balance. But what we will have now is retained earnings, because now retained earnings no longer has a zero balance. So only permanent accounts will be on this post-closing trial balance. So when we look at the post-closing trial balance here, we see we have our assets listed first, our contra assets, we have our liabilities, we have common stock, we have retained earnings now listed at 3,550, but again, no revenues, no expenses, no dividends, and no income summary. So now we've wrapped up the first year of accounting. We've wrapped up the first unit. Again, as you're preparing for the test, the best advice I can give you is practice, practice, practice. These are a lot of hard problems. They are things that don't come intuitively to us, and it just takes a lot of practice. So after you take the first test, we'll pick up with chapter 5, and chapter 5 picks up with the top of the income statement, and we're going to work our way down that income statement line by line. And when we finish the income statement, we're going to go to the top of the balance sheet and work our way down the balance sheet line by line until we get to the very end, and then we'll pick up the statement of cash flows. So from here on out, you'll have a basis for learning. You'll have some base knowledge, and I realize that that's part of what makes accounting really hard, is that most of us have no prior knowledge of accounting, or the things that we think we know are probably wrong, because we've heard people use these accounting terms in incorrect ways. But stick with it. You've done good work so far this semester, and don't let up now.